If you have ever opened your super app, looked at the balance, and felt a total pit in your stomach, this video is for you, because right now there is a massive tax break sitting inside your super account worth potentially thousands of dollars. But on June 30th, part of it disappears permanently. No extensions, no second chances. This is not a loophole or a trick. It is an official ATO rule called carry forward concessional contributions. And everything in this video comes straight from the ATO's own pages. I will show you exactly how to check your unused amount in 5 minutes. The 3 mistakes that catch people out. And at the end, the one trap that disqualifies you completely, even if you do everything else right. Quick note before we start. This is general information only, not financial advice. Here is the deal. Every year, you are allowed to put a certain amount of before tax money into super. That is your employer's contributions, plus anything you add yourself and claim a deduction on. It is called the concessional cap, and this year, it is $30,000. Back in the 2020 to 2021 financial year, that cap was $25,000. And here is the part most people do not know. If you did not use your full cap that year, and most people on ordinary wages did not get anywhere near it, the unused portion did not vanish. The ATO lets you carry it forward for up to 5 years. Count 5 years forward from 2020, and you land on right now. The 2025 to 2026 financial year is the absolute last year you can use whatever is left from 2020. At midnight on June 30th, it expires, gone. The ATO does not send you a warning letter. It just quietly drops off your account. Let us make it concrete. Say in 2020, your employer put $12,000 into your super and you added nothing. That is $13,000 of unused cap. If you have got savings sitting in the bank, you could contribute up to that extra $13,000 before June 30th. Claim it as a tax deduction this year. And instead of paying your marginal tax rate on that money, 32, 37, maybe 45%, it gets taxed at just 15% inside super. On $13,000 for someone in the 37% bracket, that is a tax saving of around $2,800. From one rule most Australians have never even heard of. So how do you find out what you have got? You do not need an accountant for this part. Log into myGov, go to the linked ATO service, then super, then information, then carry forward concessional contributions. The ATO shows you, year by year, exactly how much unused cap you are carrying, including that crucial 2020 to 2021 amount that is about to expire. While you are in there, check one more number, your total super balance as at last June 30th. Write it down. It matters enormously, and it is the exact trap I will cover at the end. But here is the catch with the deadline, and this catches people every single year. The contribution counts in the year your fund receives it. Not when you hit send on the transfer, not when your employer processes it. It is when the money actually lands in your super account. BPay and fund processing can take days. An end of financial year is their absolute busiest week of the year. If your transfer arrives July 1st, it counts toward next year's cap, and that 2020 amount is dead. If you have checked your number and you want to act, there are exactly 3 steps. Step 1, make a personal contribution to your super fund from your after-tax money. Every fund has a BPAY code or direct transfer option inside their app for personal contributions. Just make sure it is flagged as a personal contribution, not a spouse contribution. Step 2, and people completely forget this one, lodge a notice of intent to claim a deduction with your fund. It is a short form, right on your fund's website. Without it, the ATO treats your money as a regular after-tax contribution, and you get absolutely no deduction at all. The contribution alone is not enough. The form is what makes it deductible. Step 3. Wait for your fund to send back an acknowledgement letter and keep it for your tax return. Your accountant, or you, at tax time, claims the deduction with that letter as proof. One more thing while we are here. Your cap is not just employer contributions. If your employer pays your fund's admin fees or insurance premiums on your behalf, those count toward your cap too. Check your statements before you calculate how much room you've got. Going over the cap means the excess gets added to your taxable income. Quick pause. If this video has already shown you something you did not know, hit subscribe. Because every single week, I break down one super rule: the funds do not advertise. Now, who should not rush to do this? If contributing would drain your emergency fund, do not. Money inside super is completely locked until preservation age. A tax saving is simply not worth being unable to fix your car. If you have high interest debt, like credit cards or personal loans, clearing that almost always beats a super deduction. And if your income this year is low, say you are under the 32.5% bracket, the gap between your personal tax rate and super's 15% shrinks, and the deduction may not be worth locking that money away. This rule is most powerful for middle and higher earners with spare savings, especially anyone who has had a massive income year, sold an asset, got a bonus, or did a heap of overtime. That is exactly when wiping thousands off your tax bill while boosting your retirement makes real sense. And now, the exact trap I promised at the start. If your total super balance was $500,000 or more on June 30th last year, you cannot use carry forward amounts this year at all. It does not matter how much unused cap is sitting inside your myGov account. The ATO shows it to you, but you are not allowed to touch it. People see that number, contribute anyway, and end up with a massive excess contributions problem instead of a tax break. That is the exact number I told you to write down in section 2. Under 500,000, as at last June 30th, you are completely in the game. Over it? This strategy is simply not for you this year, though your unused caps from later years may still matter down the track if your balance changes. Here is the thing, June 30th is not the end of the story. The day after, on July 1st, the contribution caps actually go up, payday super kicks in, and the rules shift again. I have broken down exactly what changes and what it means for your money in the next video. It is on screen right now. See you there.